When you think about stock trading, what image comes to mind? Probably the bustling floor of the New York Stock Exchange, right? The chaotic scene where traders shout out stock prices and tickers across the room, making deals for their clients and companies. This was once the main way to trade stocks. But today, thanks to technology, most trading happens online. This advancement means even regular people, like you and me, can trade from home and try to make money. However, even though trading involves stocks and other investments, it's often seen as quite different from investing, the kind of activity most people do when they buy or sell stocks. Being a trader, whether professionally or just as a hobby, isn't the same as being an investor. You've probably heard stories of people making a lot of money from trading, but the truth is, it's not for everyone. Let's dive into why that is and what makes trading so different from investing. If you look up the definitions of investing and trading, the difference between them might not seem obvious. Investing generally means spending money with the hope of making more money in the future. Trading, on the other hand, is about buying and selling investments. So, where's the distinction? There's no official rule that separates trading from investing, but the terms are usually used to describe two very different approaches to making money. An investor is someone who puts their money into something and waits for it to grow over time. A trader, however, is someone who tries to make money quickly by frequently buying and selling stocks. While investors rely on gradual growth, traders focus on short-term market fluctuations. Being a trader can mean different things. Some companies hire traders to execute their investment strategies. For example, an investment firm might want to buy shares of a company, so they hire a trader to get the best price. In this video, though, we're focusing on traders who aim to make money for themselves. There are two key ways this kind of trading differs from investing: the timing of trades and the analysis of stocks. When it comes to timing, investing is typically a long-term game, while trading is more about short-term moves. When you invest in a stock, you're betting that the company will grow over time, maybe 5, 10, or even 30 years from now. Sure, stock prices fluctuate daily, and some investors might buy when they think a stock is temporarily undervalued, but the main focus is still on long-term growth. Trading, in contrast, is all about speed. It involves buying and selling investments quickly to profit from short-term price changes. Day trading, for instance, means buying and selling stocks within the same day, while swing trading extends the time frame to a few weeks or months. There are other styles of trading too, but they all involve relatively short time frames, sometimes even making trades within seconds. This fast-paced approach means traders make far more trades than investors and often go through many more positions. But making quick trades doesn't automatically make you a trader. There's another key difference: the analysis used. To understand how traders and investors analyze stocks differently, we first need to talk about the difference between a stock's price and its intrinsic value. Theoretically, a stock's price reflects the number of buyers and sellers trading it at a given moment. Beyond that price, there's an intrinsic value, the stock's true worth, which only an all-knowing being would know. Over time, a stock's price should align with its intrinsic value as buys and sells factor in company information. But human emotions like fear or greed can cause a stock's price to stray from its actual worth occasionally. In the investing world, people take two approaches to this information. Passive investors ignore short-term price fluctuations and focus on long-term growth. They know that even if they buy an overpriced stock, they should profit in the long run as the overall market grows. Active investors, on the other hand, try to estimate a stock's intrinsic value to buy it for less than it's worth, aiming to benefit from both the rise in intrinsic value and the stock price returning to its intrinsic level. Although these two approaches differ, they both rely on the intrinsic value of a stock increasing. Traders, however, care only about the stock's price. They don't attempt to estimate a stock's intrinsic value, and often buy and sell stocks without even knowing what the company does, focusing solely on taking advantage of short-term price swings or trends. Because of this, traders often rely on technical indicators, charts and graphs that use historical pricing data to spot potential trends or patterns to exploit. It's the kind of stuff you imagine when you think of a trader staring at multiple screens. Some traders do consider qualitative information, but usually only to capitalize on a short-term shift they expect in the stock's price. For example, if a trader learns that a company is making an announcement tomorrow, they might buy the stock, hoping the news will be good and the price will jump. In either case, traders typically focus on bits of a company's information, instead of developing a deep understanding of its operations. So, those are the two main ways trading differs from investing. It requires a different mindset and operates in a fast-paced, competitive environment. Some might even say it involves a fair bit of bluffing. This was especially true when traders used to negotiate face-to-face on the trading floor. But even today, traders often try to hide their true intentions when they place an order. If you can convince other traders that you don't want to buy something, you might be able to get it for a lower price. All this makes trading a very attractive practice for young people. Competition, quick trades, fast money, it's got it all. Plus, with all the ads showing millionaires in their private jets, claiming they went from nothing to everything with a simple trading strategy, it might seem like an easy field to break into. But trading is high risk. Most traders invest a lot of money in each trade, and sometimes even borrow money to increase their potential returns, which exposes them to short-term volatility. Trading also takes a lot of time and effort. Many trades yield only a small profit, meaning traders are constantly moving their money into new positions. And honestly, for amateur traders, there just isn't much in your favor. With such a narrow time frame, you often have to make decisions based on limited information. And when you're up against professionals with huge resources, cutting-edge research, and even high-speed trading algorithms that can outtrade you in an instant, it's just not a fair fight. Now, I'm not saying you can't make money trading. Some people do make a living from trading at home, and some companies even offer salaried positions for traders. There are some merits to it, but trading is a lot like poker. If you want to learn to trade, let me know, and I will point you in the right direction. You need to learn the right way, testing a system, starting with small live trades and learning the right way. And when you're playing against other skilled players, the odds are often not in your favor. That's why most financial advisors will tell you that investing is the smarter choice for the average person. By doing thorough research and holding investments for the long term, you're more likely to benefit from the overall growth of the economy and the stock market. Sure, you won't get the same rush as making a high-risk, high-reward trade, but that's probably for the best. If you're looking for a thrill with not-so-great odds, you might as well go to a casino. At least there, you get free drinks. Personally, I would recommend finding one mentor and learning from them, give it time and see if it sticks, stop thinking about money, and first learn the process. Thanks for watching, and always subscribe for the next one and leave a comment and tell me what I can cover next time. Remember, the universal law of giving teaches us that by helping others, we open ourselves up to receive more in return. Whether it's time, knowledge, or support, the more we give, the more we grow. So, be generous, uplift those around you, and watch how abundance flows back to you. God bless Mindset, 8 millions.